Welcome to the Deep Dive. Today, we're jumping into something really vital for anyone looking at financial statements. That's accounting changes and error analysis. We're using Chapter 21 of Kieso, Weygandt, and Warfield's Intermediate Accounting, the 18th edition, as our guide. It's a great resource.
Absolutely. And our goal today is pretty clear. We want to demystify how companies adjust their financial reporting. Whether it's a plan change or, well, fixing a mistake. Understanding these shifts is just key to really getting a handle on a company's financial health and its actual performance, especially for you, the person using those statements.
Exactly. You might think accounting is just, rigid rules set in stone, but companies actually have choices. And yeah, sometimes they make mistakes. And these choices, these errors, they can have huge impacts. For instance, Microsoft. Did you know they once changed the estimated useful lives for some server equipment? And just in that first quarter after the change, their operating income jumped by, $2.7 billion?
That's the fascinating part. I mean, that single change, just an estimate change, had the biggest income effect of any S&P 500 company's estimate change over 14 years.
Yeah.
It really makes you ask, doesn't it? Was that a real improvement in earnings? Or was it mostly just, an accounting adjustment doing the heavy lifting? That's why understanding this stuff is so crucial for you.
Okay, so let's unpack this for you. Before we get into the how, let's clarify what we actually mean by accounting changes and errors, because it's not just one thing.
Right. The FASB, that's the Financial Accounting Standards Board, setting the rules here in the U.S., they break it down. There are basically three main types of accounting changes, and then errors are their own separate category. So first, you've got a change in accounting principle. This is when a company literally switches from one accepted accounting rule, one GAAP principle, to another. Think about moving from LIFO inventory costing to FIFO, or maybe changing how they recognize revenue on long-term projects. The idea usually is to make the information more relevant, maybe more consistent, better for users like you. Okay, second type, change in accounting estimate. These happen because, well, new information comes up, or the company just gains more experience. Companies make estimates all the time, right? Useful lives of buildings, equipment, how much bad debt they expect, warranty costs down the line. As things change, as they learn more, these estimates need updating. These are considered normal, recurring kinds of corrections. And number three is the change in reporting entity. This happens when the group of companies included in the financial statements actually changes. A classic example is if a company starts presenting consolidated statements for itself and its subsidiaries, when maybe before it only showed its own individual statements.
Okay, so those are the sort of intentional changes, or ones that evolve naturally. But then you mentioned the oops moments, the errors.
Correct. Errors are different, very distinct from accounting changes. They result from, math mistakes, applying a principle incorrectly, or just plain overlooking some facts that were available at the time. Also, using a principle that isn't actually GAAP, that's an error too, not a legitimate change. And you really need to grasp this difference because how you account for it is totally different.
That distinction feels really important. Okay, now this is where it gets super interesting for you, the analyst or investor. A company decides to change a principle. How do they actually do that? Especially if you want to compare this year to last year. How do you make that comparison valid?
That's the million-dollar question for comparability, isn't it? Generally, the FASB says you have to use the retrospective approach for these changes in principle. What does that mean? Well, the company basically has to rewrite its own history, financially speaking. They recast those previously issued financial statements as if the new principle had been used all along. This gives you much better consistency and comparability across different years, which is exactly what you need. Makes it apples to apples. The process usually involves a few steps. First, they make an adjusting journal entry in the current year. But this entry updates the balance sheet accounts, assets, liabilities as of the start of the current year, reflecting the cumulative effect of the change up to that point. Since old revenue and expense accounts are closed out, this adjustment hits retained earnings. Second, they restate any prior year statements they're showing for comparison using the new principle. So net income, retained earnings, certain asset and liability numbers for those past years will actually change on the page. And third, crucially, disclosure. A detailed note in the financials is absolutely required. It has to explain what changed, why the new way is better, which years are affected, and the dollar impact on key lines like income and earnings per share. Transparency is key.
Let's make that more real. The book walks us through Lancer Company changing inventory methods. From LIFO to FIFO, how does that look in practice?
Okay, imagine Lancer started business in 2023. In 2025, they decide, we're switching from LIFO to FIFO. Then they make that switch, their recorded inventory value will change. Cost of goods sold will change. Net income will change. Retained earnings will change. This happens for all the periods they present. Usually, though, the cash flow statement itself isn't directly affected unless there are tax implications. So at the start of 2025, Lancer makes one adjusting entry. Using the book's numbers, it's something like debit inventory $5,000, credit retained earnings $5,000. That $5,000 represents the total difference in inventory value between LEFCO and FIFO right up to the end of 2024. It catches everything up. Then, when Lancer puts out its 2025 financials, they'll also show 2024 figures. But those 2024 figures will be adjusted to what they would have been under FIFO. So you reading it see a consistent trend based on FIFO. And on the retained earnings statement, they'll usually show an adjustment to the beginning balance of the earliest year presented, making that cumulative effect really clear. For Lancer, the January 1, 2024 balance would be adjusted by $2,000 in that example.
Okay, that sounds like the clean, ideal way. But you mentioned ripple effects. Or what if it's just, like, impossible to go back and recalculate everything accurately?
Great points. That brings up two important concepts. First, direct versus indirect effects. Direct effects are those immediate changes to assets or liabilities from the principal change itself, like the inventory change for Lancer. Those direct effects are always handled retrospectively. You always adjust for those. But indirect effects are different. These are changes to maybe current or future cash flows that happen because of the principal change. Think about a bonus plan tied to net income. If switching to FIFO makes net income higher, the bonus expense might go up. That additional bonus expense, that's recognized only in the current period, 2025 in Lancer's case. It's not applied retrospectively. You don't go back and pretend you paid a higher bonus last year just because the accounting changed this year. And then there's impracticability. Sometimes figuring out those past effects is just genuinely impossible, or the cost massively outweighs the benefit. Maybe it requires making huge assumptions about what management intended years ago, or you just can't get reliable estimates for past periods. If retrospective application truly is impracticable, then the company applies the new principle prospectively, meaning from the earliest date they can. The classic example here is changing to LIFO. It's often impossible to figure out what the historical LIFO layers would have been, so the inventory value at the start of the change year just becomes the base LIFO layer. No restatement of past income happens. But critically, companies have to explain why it was impracticable. That's important for you to know.
And just so we're crystal clear, some things that look like changes aren't treated as changes in accounting principle, right?
Exactly. If a company adopts a principle for something totally new, a type of transaction they've never done before, that's not a change in principle. It's just applying the appropriate rule from the start. And as we touched on, correcting an error where a company was using an unacceptable principle, that's an error correction, not a change in principle. Different rules apply.
Okay, so if principal changes generally go backward, retrospectively, what about those estimate changes? Like the Microsoft depreciation example, that seemed forward-looking.
You got it. Changes in accounting estimates are handled prospectively. That's a fundamental difference. What this means is companies do not go back and adjust previously reported results. No rewriting history here. Instead, the change in estimate affects only the current period's results and potentially future periods. Why? Well, estimates are just part of doing business in accounting. Things change, new info comes in. If you are constantly adjusting prior years every time an estimate changed slightly, financial statements would be in constant flux and probably less useful. Think about that Underwriters Labs example, changing the building's useful life. They used it for 5 years, thought it would last 15, then they decided, nope, it'll last 25 years total. They didn't go back and recalculate depreciation for the first 5 years. Instead, they took the current book value, the original cost, minus the depreciation already taken, and spread that remaining amount over the new remaining life, which is 20 years. 25 total minus the 5 already passed. So, depreciation expense changes from that point forward. Prior statements stay as they were. For you, the key is, estimate changes affect the future, not the past reports. And sometimes it's a bit fuzzy whether something is a principal change or an estimate change. If it's genuinely hard to tell, the rule is treat it as a change in estimate, apply it prospectively. This sometimes gets called a change in estimate affected by a change in accounting principle. Changing depreciation methods, for example, falls into this, prospectively applied.
And that third type, changes in the reporting entity. How do we keep comparisons valid there?
Changes in the reporting entity where the financials now cover a different group of companies. Like after a major acquisition leads to consolidated statements for the first time, those are handled retrospectively. Just like principal changes, prior periods are restated to reflect the new entity structure. This ensures you're comparing the same consolidated group across all presented years. Again, disclosure is key, explaining what changed, why, and the impact on income for all the years shown. Comparability is the driving force.
Right. Now let's circle back to errors. Mistakes happen. How do companies deal with those once they're found? Do they just fix it going forward.
No, errors need direct correction of the past. As soon as a material error from a prior period is discovered, it has to be corrected. These corrections are treated as prior period adjustments. Because the revenue and expense accounts from the prior year are already closed, you can't just reopen them. So the correction is made by adjusting the beginning balance of retained earnings in the current period. And if you're presenting comparative financial statements showing last year alongside this year, then the prior statements affected by the error must be restated. This isn't just recasting, like with a principal change. This is a true restatement because the original numbers were factually wrong. Companies also have to disclose the nature of the error and its impact. They need to show the effect of the correction on each financial statement line item and earnings per share for each prior period presented. And they have to show the cumulative effect on retained earnings at the start of the earliest period shown. For you, this is a clear signal. The previous numbers you saw were wrong.
Let's use that book example. Selectra Company forgot to record $20,000 of depreciation in 2025 and found out in 2026. How does that fix look?
Okay, so in 2025, the impact was depreciation expense was too low, which means net income was too high. On the balance sheet, accumulated depreciation was understated, so the asset's book value was too high, and maybe related deferred taxes were off too. So in 2026, when they find it, they make a correcting entry. It would likely involve debiting retained earnings to reduce it for the past income overstatement, maybe adjusting deferred tax liability, and crediting accumulated depreciation to increase it to the correct balance. Then, on the 2026 statement of retained earnings, you'd see an adjustment to the beginning balance labeled prior period adjustment. And if they show 2025 statements next to 2026, those 2025 numbers will be restated, showing the correct depreciation, the lower net income, the right accumulated depreciation, etc.
Okay, I heard people talk about big R restatements and little r restatements. What's the difference, and why should we, as users, care?
Ah, yes. That's a really practical distinction based on materiality. It's crucial for you. A big R restatement is for errors that were material to those prior period financial statements when they were originally issued. These are the serious ones. They require formally restating those past financials, often involving regulatory filings like an 8K with the SEC. It basically tells investors you cannot rely on those previous reports. It's often seen as a major red flag about controls or past reporting quality. A little R revision, sometimes called a revision restatement, is different. This is for errors that were immaterial to the prior periods individually, but correcting them now, maybe in aggregate with other errors, is material to the current period's results. They still correct the prior period numbers in the comparative statements, but they don't typically require the same level of formal notification and filing as a big R. The distinction can involve significant judgment by management and auditors. For you, while maybe less alarming than a big R, a little r still indicates past inaccuracies and might raise questions about internal controls or management's judgment around materiality.
That's a helpful distinction. Now, thinking about errors, do they all stick around and mess up the books for the same amount of time?
Not at all. Errors that hit both the balance sheet and income statement often fall into two types based on how long their effect lasts. First, you have counterbalancing errors. These are errors that, by their nature, automatically offset or correct themselves over two accounting periods. A common example is forgetting to record accrued wages at year-end, let's say in year one. That understates expenses, so year one income is too high. But then in year two, when the wages are actually paid and recorded, year two expense is too high. It includes year one's forgot expense, so year two income is too low. Over the 2 years combined, the total income effect washes out. It balances. So if you discover a counterbalancing error after the 2 periods have passed, you actually don't need a correcting journal entry because retained earnings is already correct. The error fixed itself. However, and this is important, if you present comparative statements covering those years, you still need to restate those individual prior years so each year shows the correct income. If you find it before it counterbalances, say, during year two before closing the books, then you do make a correcting entry to get the current year accounts right and adjust retained earnings for the year one impact. The other type is non-counterbalancing errors. As the name suggests, these don't automatically offset in the next period. Think about incorrectly expensing the cost of a piece of equipment instead of capitalizing it, treating it as an asset. In year one, you immediately overstate expenses and understate assets. That error doesn't just fix itself in year two, its effect lingers because you should have been recording depreciation expense over the asset's whole useful life. So net income will be wrong in multiple future years, and the asset will be understated on the balance sheet until it would have been fully depreciated. These always require a correcting entry whenever they're discovered to fix the asset balance and retained earnings. The key thing for you is whether the error has a short-term, self-correcting impact or a long-lasting one.
Wow, it sounds incredibly complex to manage correctly within a company. There are so many layers.
It really is. And it underscores why things like professional judgment, striving for accuracy, ensuring full disclosure in the notes, and maintaining neutrality in reporting are so absolutely critical. The whole point, the end goal, is always to provide you, the user of those financial statements, with the most faithful, reliable picture of that company's financial position and performance. It's a constant balancing act, really, between making things comparable over time and dealing with the practical realities and costs of accounting.
Okay, everything we've talked about gives you a really solid grounding, especially if you're looking at companies reporting under U.S. GAAP. But we have a global audience, so how do these rules for changes and errors stack up against international standards, like IFRS?
That's a really important question in today's global economy. The good news is GAAP and IFRS have actually converged quite a bit in this specific area, mostly thanks to IAS 8, the relevant international standard. There are definitely similarities, for example, how they handle changes in estimates. Very similar, both use prospective application, and both GAAP and IFRS allow for that impracticability exception for changes in accounting principles. If going back retrospectively is just too hard or costly, they both allow a prospective approach as a fallback. But there are a few key differences you should probably be aware of. One relates to error correction. Under GAAP, if there's a material prior period error, you must restate. It's mandatory. Under IFRS, believe it or not, that same impracticability exception that applies to principal changes can also apply to correcting errors, though likely only in very rare circumstances. So a slight bit more flexibility there, potentially. Another difference is around those indirect effects of principal changes we discussed earlier. GAAP has pretty detailed guidance on how to account for them, remember, prospectively. IFRS, under IAS 8, doesn't explicitly address indirect effects in the same way, so there might be a bit more diversity in practice internationally on that specific point.
Well, that brings us to the end of our deep dive into accounting changes and error analysis. We've covered quite a bit the different kinds of changes, how they're put on the books, retrospective for principles, prospective for estimates, and that crucial process for correcting errors.
Yeah, and we've highlighted how these adjustments can really change the numbers you see, the financial picture being presented. And we've also touched on those subtle but potentially important differences between U.S. GAAP and IFRS.
So after all that, what's the big takeaway for you, our listener?
Well, I think it raises a really practical question for you to consider. Given this range of choices companies have in accounting methods and the fact that errors, well, they do happen, how can you, as a really sharp financial statement user, take this knowledge and maybe challenge the face value of a company's reported earnings? How can you dig deeper to understand what's really driving their financial results versus what might just be, the impact of an accounting adjustment or an error correction? What questions should be running through your mind now?